Welcome to Inside the Road, the podcast where we speak to the leading minds in wealth management. I'm your host, David Clark, and I'm joined here today by Tom Oriel, my fellow partner here at Coda, and we're presenting the podcast with Chris Aylward of ASA. Welcome, Tom. How are you going?
Yeah, good. Thanks, David. How are you?
Yeah, really well. Thanks, mate.
Great. We've got a fantastic podcast ahead. Chris Aylward, one of the property titans of Australia, I guess you'd say, founder of APN Group that sold to Dexus. What are some of the key things you're excited to talk to Chris about?
Yeah, I've got a bit of a shopping list of things I'm excited to talk about in terms of just his industry experience. You'll see he's super experienced and been through so many cycles. So I'm really interested to hear about his involvement with there's these iconic buildings in Melbourne and Sydney CBD, which he was involved in building with the Grollos. Just sort of fascinating background and that being built. Then sort of at the birth of sort of A-REITs in Australia, building the APN building, building that platform and then selling that to Dexus, how they went about that, how they think about that. And I'm really interested, given he's managed money through all of these cycles, how he thinks about different points in the cycle and where he thinks we are now.
Yeah, absolutely. I think the fact that he's been investing now since the 70s, he's gone through the floating of the Aussie dollar, the interest rate cycles, the early 90s, the recession in Australia through to today. What his thoughts are around cycles and adding value on top of that and how he's managed that whole piece around development, construction and property in Australia should be fascinating.
Let's get into it.
Good one.
For having me, David.
Pleasure. Chris, perhaps you could start us off and for the benefit of our listeners, give a bit of background to who is Chris Aylward.
Yes, Dave. Well, seeing we're talking about property, I suppose the best way to describe me is a person who's been in property since 1971, 72, and started as in residential real estate as a property manager. Have no formal qualifications in real estate, but went to Melbourne University, was a bit of a shocking student, and went and worked in the mines in Western Australia for a couple of years before I came back and got my job in real estate. And got married in 1975, and by that time I was selling residential real estate, and my wife and I decided that wasn't for us, so I got a job with what's now CBRE. It was called Richard Ellis, Salmon and Seawood at the time, and I started there as a leasing agent, so leasing office buildings such as BHP, 31 Queen Street, which I see is back on the market now, the Syndicate, Collins Place. So, I'm a bit of a dinosaur. So moved from leasing into city retail, shifted firms. The firm no longer exists that I moved to, but so I became a bit of a specialist in CBD retail for a year and a half, and then Richard Ellis said, come back. So I did, and a couple of years later I was sort of in charge of city sales and projects, and had a number of clients, Leighton's Properties, Westpac Trust, sold a lot of stuff up and down Collins Street, so Melbourne expert, Melbourne born and bred.
To that effect, I think a little birdie might have told me that you had a stint as a tram conductor, which fits into the Melbourne born and bred. Is that right?
I think that was before I got my university result, which it was a summer holidays job, and it was very interesting. So I was the first tram out of Preston Depot on New Year's morning, and I slept the whole way into town. So I think I got home about 3 and got to the depot about 4:30. So I wasn't the world's best tram conductor, but it was another good experience. The sort of things you do when you're kids. And but I wasn't hopeful of passing. I can tell you, I knew the news would be bad. So but that was part of my
Chris,
Melbourne background.
Am I right in thinking that the arc of your career is in property has been, really unique in that start that you're talking about at Richard Ellis. Then you went to Grocon, is that right? And you were, the research I have indicates that you were a personal assistant and development manager in 84, and then you were on the board in 87, which seems to be quite a move or change. So I was really interested, A, is that right? And B, how does someone go from that level to that level so quickly?
Yeah, well, as an agent at we'll call it CBRE, for the sake of...
Yep.
I sold the Grollo Brothers, the Rialto site, and I don't know when that was, but it must have been about 1983. So I was quite young, quite ambitious. And, I think, it was an enormous undertaking for them. And they were worried about leasing the building up. So they said, come and join me or join us. I did know them. I was a Thornbury boy. They were both Italians in Thornbury, concreters. Used to see their trucks going around. I knew their parents. So sort of knew the family, and was sort of a bit of a trustee. So, but we did work in 84. I worked on the Malvern Central Shopping Centre, the Terrelgan Shopping Centre, various other bits and pieces. And the world was changing. The background was changing. We had deregulation. We had Keating. We had floating of the Australian dollar. Whole lots of things happening. And trying to bring that 84, 87 bridge together for you. And at some point, I said to them, look, you guys are making more money out of construction than you are in a development, because they had been builders and then they moved into development and were very successful. But I just said, you're making more money out of construction than you are out of development. And they sort of said, well, we've never made any real money out of construction. So, if you think that's possible, then, we'll set up Grocon. And so I suppose the backdrop was also that they could control the unions. There was a lot of unfounded rumours as to how they did that. But they basically did that by having an army of Italian men who loved working for the Grollos. There are about 450 of them. So we were essentially form workers as well as builders. So very vertically integrated for builders. And I suppose, when I talked about the backdrop and Keating, I think the institutions were sort of seeing that property was approachable, that they could actually get into the development business if they got a reliable builder. So there was Roberts in Perth, there was us in Melbourne, and I think it became possible for them to develop. And so Grocon was set up in 87. The staff owned 30% of Grocon and the two brothers the other 70. I had half of the 30%. And my job was to go and get the work and then make sure that it was done profitably. And really, I could not have done that without Bruno and Reno Grollo. They were just fantastic mentors and fantastic people to work with, and had a fantastic army. And, that's what led to me sort of becoming a director of Grocon in 1987. So, and a founding director. So what was I by that time? 35. So.
And what were some of the key things that you learnt from them that's held you in good stead later in your career?
Well, Bruno Grollo reminds me very much of Donald Trump. He was happy to be underrated and be sort of not treated as a buffoon, but just, he was just happy to sit on his side of the table, negotiate patiently the way he wanted to negotiate. And in the end, he used to end up with most of the chips on his side of the table. So he's this fantastic negotiator, very patient, never rude to people, well, a bit unlike Trump, but never rude to people, and always focused on the outcome. Now, in terms of the background, it was, the business had been set up by their father, so the organisation, I didn't learn much about the organisation, except, Reno Grollo was fantastic at organising the form workers in the morning and getting the boys on the trucks and getting them to their spots. And I mean, it was just a fantastically organised business. But I must say, by 87 or thereabouts, I mean, Bruno had been working in that business since he was 13, because his father didn't speak very good English. So he'd been negotiating, a bit like the kid you see, the Asian kid in the laundry, collecting the money. He was the same sort of person. So I think they taught me just the basics, just concentrate on the basics. We're here to make a profit. We're here, and maybe they taught me how to read the markets a little bit, like the other thing that was happening is interest rates were going through the roof. So, being builders, we had to be able to offer security to our clients. And we did that by fixing prices and fixing contracts. In the days when, premiers didn't wear high-vis jackets and hard hats, when you were real builders and you had budgets. And so, very outcome focused. So, I suppose my job was I'd find the job, then I'd put together the project team, if it was a development, and then I'd manage our project manager until such time as he was ready to take over. So very basic approach to business. If it was a pure contract, we might look to sort of get a design construct so we could control the process rather than be relying on project managers and third parties. Because interest rates were rocketing, these fixed price, fixed time contracts, we'd actually charge a premium to fix the price.
Yep.
Which, if you of course could do it, was profit went straight to the bottom line. So how to manage risk, I suppose was a big thing Bruno taught me, but they worked so hard for so long to create this risk management team that we had our moments. We did get a few things wrong, but when I look at the buildings that we built, Governor Macquarie, Governor Phillip, 101 Collins, the casino was the last contract I signed before I retired. So, there was some iconic sort of stuff there, and it mostly, the bigger it was, the better we managed the risk. The smaller contracts weren't as profitable, but just fantastic times. And I think I, learned a lot. But, we're basically all fairly basic people, just, sort of, I don't think we're interested in Grocon being as, having a logo like Telstra, but, it just sort of happened, it happened.
It's some pretty iconic projects that you talked about there, Governor Phillip Tower, either 120 or 102 Collins Street, some real significant skyscrapers that have left their mark on, Australians' central business districts. What similarities, if any, are there in managing a company building skyscrapers and managing an investment fund?
Yeah. Well, we did do a couple of developments. So, we always had our eye on the property market. And it was a means to an end, we just saw that... I think Bruno said to me at one stage, "If we'll never see these prices again in my lifetime, you might." So it was, I think, were his exact words, because he was 10 years older than me. But we're always property people. We were just using the construction company as a vehicle to make money. Essentially, and but we had a joint venture with Consolidated Press on 120 Collins Street. We developed what was to be the headquarters for the State Electricity Commission of Victoria. We had some really tough negotiations, like the SECV got closed down during construction. 120 Collins Street, Al Dunlap arrived on the scene. It's just, it was sort of a history. Governor Phillip Tower, the State Authority Superannuation Board, decided that they hated the development midway through it and didn't want to go ahead with Governor Macquarie Tower. So there was just it was an intense period. So, we went from boom to bust So I think the last contract I signed was the casino in '94. So it was a 7-year period. So as you can imagine, it was a really big boom in the late 70s, late 80s, with all of those things I was talking about before, deregulation. And then the high interest rates just smashed commercial property, smashed residential property. I think, when I look back, it was the biggest recession that we've had, the early 90s in Australia. So,
and to give some context to some of our younger listeners who are talking about high interest rates now having come off post-COVID lows and the readjustment we saw sort of 22 to 24 in commercial property, those interest rates, I want to say, topped out early 90s, call it 92 at circa 20%, if I'm right. And those sort of rates are just unthinkable for people who have been in and around markets for the last 10, 15 years only. So you're really talking about a different time. And then, of course, Chris, you founded APN in '96. What was the opportunity you saw there to do that?
Yeah, well, I founded it with Bruno Grollo. We invited Reno in, but he didn't come in. And a guy called Andrew Cruikshank. And Andrew was really the instigator. He worked for me at Grocon and was still working there after I left and wanted to do something different. I didn't really want to do it, but I liked Andrew and Bruno, and, I wasn't doing much else. I'd sort of bought a block of land, was establishing a winery. But I think we decided, as long as it was middle market, as long as it wasn't all that pressure, as long as we were away from unions, not that the unions worried me, they were sort of Bruno's sort of habitat. But as long as we were doing stuff that was manageable, and we just set about doing it. I suppose I did the strategy with him. He did the management of the business, did a terrific job, and we just took on a couple of guys, Peter Hart, who sort of has become quite a successful developer in Melbourne, and John Lockie, and we started off with a private hospital down in Frankston. Which became part of the Newmark Group. We built the Porsche Centre in Collingwood. We built the aged, must have been the last print centre in the world, out near Tullamarine Airport. We built a 20-storey building in the city, on the fringe of the city. We renovated an old building in partnership with HIH, who went broke during the development in Collins Street. There's about 280 apartments, which we renovated. So, look, it was middle market sort of stuff, and it was very, very successful, went on for a long time. And then Howard Brenchley approached me. Howard was sort of a doyen of, he was on your side, advising, and wanted to set up a fund. And he came along with a partner called Rod Kewen in 1998 and said, would we fund a funds management business? And I didn't know Howard. I might have been to one of his seminars, but had a great reputation. So I just said yes. And he set up what was to become the APN Securities Fund. Now, it took 2 or 3 years to get that going. In the meantime, we were developing in the background. He separated from Rod, which was a bit bitter. We sided with Howard, and then 2001, 2002, all of a sudden the money was just flowing in the door. It was like, I can't remember the exact figures, but certainly, it went over $1 billion. And by 2005, we were a fund manager rather than, we were still sort of doing our developments in the background, but we had become morphed into a funds manager. Somebody said, why don't you take this public? And I don't know whether stupidly or cleverly, I sort of didn't resist. But I think we all agreed that we needed a managing director who had experience in public companies. So we got Clive Appleton joined us from the Gandel Group, and I don't know what we had. We put together a development fund as an adjunct to the securities fund. So we had two funds, and I'm not sure when we went ahead with the European fund, but it was probably around about that time. So we jettisoned the construction development sort of business and became a pure fund manager, and listed in 2005. I had previously bought Bruno out of the bought Bruno out of the funds management business. I just said, look, I'd like something of my own. I've always worked for you. We've always been partners. I'd like, and this was. There was no inkling that it was going to be successful at the time. He said, sure, if that's what you want, then do it. So I ended up with a majority stake in the listed company. Andrew Cruikshank sold his shares and went his own way and into the float. And we headed off with Clive Appleton as managing director. So I don't know. I'm sort of, as the opportunities sort of presented themselves, I sort of looked at them and just decided whether they were for me or not. And we really have only made one serious mistake, I think, in my 50-odd year career, and it wasn't the listing. It was the European fund. So,
tell me about that European fund, because you've managed property and been around property through some pretty significant crisis, right? So, the Black Monday stock market crash, I want to say in 1987 was a circa 20-30% drawdown. Everything sort of imploding around the tech bubble, which was 2001, was a big drawdown. The GFC was a large drawdown. But I'm interested to hear, you said there's one mistake in that European fund. What was the mistake? What did you learn from it?
Well, I think the mistake was just basically, as a fund manager, you really are in conflict. You're building your own business and managing other people's money, and how you manage that conflict is the key to me. And we didn't think we could do Europe by ourselves. Everybody was heading to America at the time, so we thought, well, why not Europe? Took property. We know a bit about property, and anyhow, we took on a partner, and it just became obvious after a while that the partner was more interested in making acquisition fees and looking after our investors. So I went to London, and we reinvented the thing. We bought them out, which probably stupid, probably shouldn't have paid them anything, but anyhow, I must have been feeling generous at the time. But we bought them out so that we took control, and we set up our own office in London. And Tim Slattery, who's now the CEO of ASA and was the CEO of APN, he came and joined me in London, and we set up our own management business and took control of the property management of the assets across Europe. And, about that time, Bruno and I sort of made a significant investment in the fund. We thought we'd saved it. We really thought we'd got to the bottom of the issues. And, of course, then RBS went broke, and Spain went broke, effectively. But that wasn't, that was bad. And we'd managed those sorts of things before, but we had bought assets, and we'd paid 50% debt, but we'd paid too much for the assets, so we weren't 50-50. By the time the assets were repriced, we were well underwater. And so I think the lesson was, don't necessarily have partners, but if you do have partners, make sure that they're the right sort and never pay too much. That seems to me to be the. And, so that was part of the acquisition model that, I didn't like, that these guys were just sort of paying up for assets. But by the time we resolved it, by the time I so I suppose as a private person trusting people running public companies, I was a bit on the out. But then I decided to trust myself, get back involved, tried to tidy it up. But, it was really too late. And so that was the one regret that I have.
Yes.
But it taught me a lot, because we had obviously had a number of investors along with, and just how patient those investors were. They were like I had, because we were co-invested, because we were sort of going down with the sinking ship. There seemed to be a bit of a camaraderie, and those people were incredibly patient. So I think it taught me that people do understand risk when they give other people their money. Not everybody's going to ring you up and want to shoot you, but there will be the odd one if you don't do the right thing. But we tried to do the right thing. We tried to remedy it. We just it was just beyond repair, because of a few fundamental issues.
And Chris, you've been through all sorts of market cycles and seen a lot in property. You're probably forgotten more than I know in the area. I'm really interested in your thoughts on where the market is today. I sort of prefaced earlier in our conversation the fact that, post-COVID, and you saw this huge interest rate rise in relative terms from sort of zero up to call it 5%. So, from a percentage terms, that's a big move, even in absolute terms, nothing like the 19-20% you saw in the early 90s, along with inflation and the cost of building, and a lot of builders, developers being caught out on fixed quote pricing, making it very hard. And I think, we saw some real negative performance, and added to that, you've got this whole sort of work from home thing that's changed to a degree, with offices particularly and CBD. And I think, Melbourne's probably felt the brunt of that the most. I would actually, really interestingly, incidentally, in talking to colleagues and people in the US, I would say there's a lot in the US where it's really been hit hard, and they just still haven't recovered. This donut effect where the cities have been hollowed out and the suburban areas have taken off. Places like San Francisco, where they worked out that they could pay their tech employees the same money and they'd all work from home, and the production seemed to be about the same. I'm really interested in your thoughts about where we are in the cycle at the moment. It appears that, in Australia, if you look across office, it's sort of recovered a bit, and last quarter was positive. Industrial, it would seem that, logistics has been the flavour of the month for the last 4 or 5 years, since Amazon and online and third-party logistics has just been under huge demand. We saw an industrial property sold by one of our clients on a 3.8% yield at the end of 21, right, to Stockland for north of $120 million type of thing, and then even retail seems to be going okay. What's your view on where we are in that cycle at the moment? The only other thing I would add to that sort of view that I have, which is probably erroneous, I want to hear yours, is that there seems to be more money in the system and more people chasing deals than ever before. What's your view of where we are in the current commercial property market?
Well, to answer that in my way, so in 21 we sold APN. The reason we sold APN was, well, as a listed entity, it was never valued at what we thought it was worth, and then we got a premium to what we thought its value was.
So $320 million to Dexus, was that right?
That's right, yeah. I'm not sure how the options were treated. It might have been a little bit more than that, but anyhow, it was a good price from our initial entry of about $1 million in 1987.
Yeah, that seems to work.
1996, sorry, I should say. So it was a pretty good deal. The reason we sold is I just couldn't see anything to buy. I'm sort of picking up on your line. There were so many people in the market that they were paying ridiculous prices. It just seemed to me that there had to be a re-leveling, because it had taken us a long time to put those $3 billion or $4 billion worth of assets together. I think we would have put together a lot more had we not had the European fund, but we had a long time repairing reputations and rebuilding relationships. So that's how I saw the market then. I saw it as a peak. I saw industrial as bloody ridiculous. I mean, sort of a bit of concrete with a bit of aluminium walls and a roof, and and warehousing was going to go on forever. I think when people talk about work from home now, and they forget that there was an overbuild of office space.
Mm-hmm.
Retail was probably a bit of the outlier because of the Amazon and the online sales. So there wasn't quite as much froth in retail. But it was just essentially a crazy market. And I still think it's a crazy market. If you do a feasibility and the land has a negative value, then that's a crazy market. So we're finding it, now that we've set up this ASA business, we're finding it not impossible, but we've sort of got to keep our wits about us in terms of finding value. So in terms of this, I don't really understand the industrial market. It's never been my area. One of our guys here, Alex Abel, managed the industrial fund, so he's very good in that area. But we did predict that the yields the cap rates were too low, and I think they've gone back up a bit since. The office space market interests me. I think it's a 10-year cycle. Back in the 90s, we started buying sites again in 2002, 2003. I don't think the work from home's a big issue. I mean, the press talk a lot about it, but you still got to have a seat, and you've got to be there 3 out of the 5 days a week. And even with hot desking and various others, I don't pay a lot of attention to the detail, but it just seems to me like that's a story that the politicians and others are selling, but essentially people like to club together. So we've overbuilt. That's the biggest problem, because of the free money that was out there, the 1%. I mean, that was the problem. It's not the 7 or 8% that it went to. It was the 1% that it got to beforehand, which created the liquidity. Everybody was a genius. There was property developers falling out of trees. I mean, it was easy, and it was just so obvious that it couldn't last. So now I think that we're 5 or 6 years into that recovery cycle on offices. Maybe if I come back to them. But I feel fairly positive that it's a hockey stick. It's just a question of how long the lower bit is, But I think that the handle's 4 or 5 years away. But we'll come back to that. And on retail, retail's just been an absolute bargain in the listed space. Some of these convenience retails have just been, But now the listed sector is repriced a lot. Not the last couple of months. I think it's come off. I follow it quite closely. So it did rally up. I mean, if we use CQR, I think it got to $3.30 or something. I might have the handle wrong, and it's now back to $3, so it's off 10%. But it was down at $2.40 or $2.50. So and now everybody wants to buy retail, but 30-year bond rates are over 5% and retail yields are 5%. So you're getting nothing. It's the risk-free, or the risk return seems to me to have gone. I mean, the time to be buying retail was last year or the year before, when we sort of bought this fund, which is sort of heavily retail oriented. Not saying we bought it and the assets are cheap. I'm just saying that at least somebody would pay a lot more for that fund now, I think, than we did. So I'm my gut feel is that it's not over in Australia, that these higher interest rates, Michelle Bullock's having a tough time, but it looks like inflation's going to get sticky. So, if the 30-year bond rate here is over 5% and it's over 4.5% in America, then, I think property is going to have a hard time, particularly when you've got negative values on inputs for land and things like that. So everybody talks, I won't wax too lyrical on all that, but it would seem to me that back in 1987, we had Paul Keating say this is the recession that we have to have, and that could be on somebody's lips inside. I don't know why, because we keep absorbing it, we keep printing money, we're marvelous at doing that. We're much better than we used to be at doing that, and it looks like we can levitate this thing forever. But I suspect behind all of the issues of the residential problem and everything else, we've got this interest rate issue. So the way we're dealing with that is, we're probably starting to look towards commercial, where we can borrow money at 5%, but get in excess of 7% returns. We'll leave retail to others, and we'll let for the time being, there's opportunities that offer a positive spread, I go back to Bruno Grollo selling all of his real estate in 1987 after the crash, and I know he would always buy, and I know most of those old property guys, Triggerboff and all of them, if interest rates were lower than returns, they'd always be buyers. So I think we're sort of looking at the market a little bit that way at the moment. If we can get a positive return out of an asset, and we can get when I say positive return, not just a number, the actual income has to be there for a period of 3 to 5 years, say, unimpaired, and that throws off 7 or 7.5%, then we're in the market. I don't think we see, massive collapses, because it's going to be solved through time. It's the only way it can be solved. Gradual inflation is going to solve this. I hear lots of the private debt guys, I shouldn't call them Johnny-come-latelys, but, because they're good at what they do, but they're back in the market, and there's lots of liquidity out there, and it just sort of, so for me, that's scary. For them, that's good. But I do remember the Babcocks, and I do remember the Orcos, and I do remember all those things that happened back in 2007 and 2008. So having a memory is not necessarily a good thing at times, but I think we'll always be, and businesses I'm involved with will always be fairly conservative. So does that answer your question?
It does. I want to get on to ASA if I can, and why. Sure. But before I do that, I just want to pick on a little comment there, because obviously there's a lot of media around private debt, and I want to say the vast majority of private debt in Australia is real estate backed private debt, as opposed to the US. So we're really talking about that. And I'm interested in your thoughts about the comment you made about the Johnny-come-lately. What are you seeing in that area? I have a perception that, if you've got a really good, experienced lender who understands property, and the banks aren't playing in that area where they should be, there's a really good opportunity on a risk-return basis to get almost an equity-like return with significantly lower risk. However, in the last couple of years, as that area has grown off a very low base, you've seen every asset manager in the world, well, it feels like every asset manager that's had a fund doing Australian equities or property, everything else has popped up with a private debt fund. And I'm not sure they have the terms and conditions and experience, that some of the people who have been in markets a lot longer and have, had deals go upside down. What are you seeing in that private debt market that worries you a bit?
I think it's just the liquidity, just what you're talking about, the amount of money flowing in that direction. I think a few of the developments are actually being funded without pre-sales by the debt provider, who will presumably take the titles on completion. But the risk is that we go into recession and they get caught. You know, I mean, that's the only risk. I mean, if everybody keeps elongating this, then they will survive. But the guys with the track records, I can't mention names. I know a lot of these people.
Sure.
I'm friends of theirs, you know, and I really respect their business abilities. I'm sure they will come out the other end of it.
Yeah,
fine. But already we've seen a few victims. You know, I mean, we've seen some sales of businesses, and if you look beyond them, I mean, I think some of those people would prefer not to take on partners or prefer not to have sold their businesses. But you know, it's been pretty tough the last couple of years, you know, so...
yeah.
And I suppose the other thing about debt, you know, I got offered this fund in America, you know, and it was going to pay me 9%. And I had a mate of mine who's a fund manager look at it from the other side as to what the borrower would have to pay them to pay their upfront fees, to pay their ongoing fees. And he had to be paying, you know, roughly 16% for them to pay me 9%. Well, I think that's usurious. I think that just means that the borrower, the ultimate borrower, is at risk. And, you know, they're just times to be careful. Not... I'd love to be, you know, diabolical and sort of say there's a crash coming, but I mean, I've learnt that you can't do that because they just don't happen very often. But you should be wary of market circumstances. And to me, you know, there's an affordability crisis because people can't afford houses. You know, like, I mean, they're too expensive. So that's just got to be worked out through time. So if people aren't making enough to buy the asset, you know, why are you providing it?
Yeah. So, Chris, I'd like to talk about ASA. What is it and why did you do it?
I thought you might ask me that. Well, ASA is a fund. It's a fund manager. And Tim and Alex, two guys. I should say that in that period of APN, you know, one of the things I was proud of is how many people made a lot of money, you know, other than me. You know, there was a lot of guys that did very, very well along the way. You know, we probably created 10 or 12 multi-millionaires. So the boys, after we sold APN, Tim and Alex just approached me a bit like Andrew Cruikshank did all those years ago and said, look, our time's up at Dexus. You know, I don't think they were going to be made CEO or the career path was not where they wanted it to be. So they just said, you know, how about we get together? And I said, as long as it's a partnership, you know, I don't want to be the senior partner or anything, you know, so we pooled our money and we bought a fund. We bought a fund of Australian Unity. Mm-hmm. And we're equal partners in the fund manager, and we acquired the Diversified Property Fund. So I suppose, why did I do it? Just for an interest. It keeps me a bit young, relating to the young people. I'd worked with them for a long time. I trusted them. I think that Tim as a corporate finance guy, you won't get anybody better. Alex is a property guy, you know, reminds me of me, you know, many, many years ago. So they look to me to be a pretty good team. You know, we'd done it in the past, and we'd done it successfully, and we weren't embargoed from doing it again. So, you know, why not? You know, it just seemed to me a reasonable sort of thing to do. And as I say, we've acquired this fund, and where we go from here, I mean, well, you might prompt me with a question or two, but...
Well, I'm interested. The biggest asset in that fund from Australian Unity, I think, if people are from Sydney, they'll particularly know it, particularly if they've driven up and down, what is it, the M1, the freeway going north, is the service station there, which I want to say, is it an Ampol? It used to be a Caltex, might be a 30, 40-year lease. You know, big. I think they're the busiest service stations in Australia.
Wyong, yeah.
Wyong, because
I can tell you where it is. I can't tell you what the brand is. Believe it or not.
Yeah. It's now Ampol, it was Caltex, and you know, I think there was a McDonald's at now Burger King there, and you sort of stop when, you know, everyone needs to go to the bathroom or you need to refuel the car. So they're the busiest service stations in Australia. But I'm intrigued, you know. And the obvious question that comes to my mind is, where are we with EV and driverless cars? You've got a 39-year lease there to Ampol, I want to say. So that's a good risk, but what's the value of that land at the end of that period if we're all driving around in driverless vehicles that are battery operated and go a lot further so you don't need to stop type of thing? Was that in your thinking at all when you bought the property and have a view on that, or?
Well, I think we had the convenience REIT at APN, which was acquired by Dexus, and it's now the Dexus Convenience REIT, and I own shares in that. And so we'd sort of looked at that electric vehicle use, and obviously a bit of a concern. But, you know, when I spoke to the guys at Puma, who ultimately sold to Chevron, Puma were owned by Trafigura, I think, and which was somehow tied into, back into Australia. He said, look, we're fuel merchants, we're not petrol merchants. You know, we'll sell you anything, you know, like we'll put in charging stations, we'll do this, we'll do that. So I sort of bought that story. It was a sort of a top of the head sort of comment. And I think it's sort of proved so far to be right. When I look at the statistics, the penetration of electric vehicles look to be, you know, sort of accelerating, and then whether people decided they didn't like Elon Musk and stopped buying them, or, you know, maybe he did us a favour, not quite sure. But I think you can overreact to that stuff. There will be a time to sell that asset, I think. You know, it's obviously, but, you know, when I talk to the boys, they say the growth is there, and, you know, the 3% per annum, or it's the greater of CPI, or, you know, it looks to be well hedged in terms of growth, even though the yield's low. So it gives the fund a stable, very, very stable income. So worry about it. Yeah, I worry about all those things that you're sort of talking about, but not too much, you know, really and truly. I mean, you can sort of worry about everything. It seems to me an extraordinary asset, busiest service stations in Australia on the busiest road between the two biggest cities. Diesel is a big part of the sell. It's not just sort of petrol. They're putting in, you know, sort of recharging stations. Then you've got the convenience sales on the side. So I think you can concentrate on the one negative, but to me, you know, there are lots of positives. A good analogy might be Amazon, you know, sort of 10 or 12 years ago, which flattened retail, and retail's the country's, it took 15% of the market, online sales, but the economy is 15% bigger. And there hasn't been any development in retail. So yeah, all of a sudden it's supply constrained and the market's got bigger. So who knows? The future is a mystery, David.
Yeah, I had a look at the asset, and it's quite interesting. Some conversations with Tim, and I think I'm pretty comfortable. You know, it's interesting if you look at the MP, you know, the net present value, and you do some forward cash flows even on that lease, and if you assign no value to it, where obviously, you know, there's going to be some sort of logistics or something off it at the end, you know, the numbers still sort of work just because of it. It's, you know, the pricing of it. So very good. Chris, you've been really generous with your time, you know, and the access to this type of experience and story over the last, you know, since the early 70s through to now in property. That sort of insight and view is hard to get. So I thank you very much for sharing those stories with us and those insights. Thank you very much for joining us at Inside the Rope and sharing those insights. All the best with the new venture, which seems to be off to a very solid start. Thanks for joining us at Inside the Rope.
Thank you, David. Thanks for inviting me.
So, David, really interesting episode. I made a few points following that with Chris, and I'm just really interested in your thoughts following that episode. And what are some of the key things that stood out to you?
Yeah, lots of history there, right? And lots of experience. And it kind of reminds me that in wealth management, given where it's come from, largely around superannuation, a lot of stockbroking, you still see today that, ultra high net wealths globally hold about 30% of their portfolios in property. And I think a lot of advice houses are just guilty of rolling out things that aren't property or excluding it. So I think, you really have to think about it and work out where it sits in people's portfolios. A couple of things that really stand out to me is just how long these cycles can be. And Chris talked about, how they identified retail sort of 10 years ago, and how he talked about office at the moment, how it's kind of been hard and on the nose given work from home, COVID, AI, and that now it's perhaps the time to be buying office because in 10 years' time, the oversupply that he refers to is going to be taken up and it's going to be in a much better position. Just how long those cycles are. I also get the feeling that, it's just tougher. There's more people looking and it's a more crowded market.
Yeah.
It kind of feels back in, his time that, there weren't a lot of people doing
what he does.
Exactly.
Yeah.
So it just feels a bit harder. And he said in his episode that, there was, opportunities are hard. We've got to be patient.
Yeah, exactly. And I think that whole piece about patience, he talks about how wealth is compounded and patience being key in both accumulating wealth, but also in downturns, staying rational. That was a really good takeaway. The piece that stood out to me was actually when he talked about tough times and the 90s recession. Being a millennial myself, I think when we think about recessions, we gravitate toward the GFC. But it's really important to listen to people with a wealth of experience talk about how tough the 90s recession was in Australia.
20% interest rates.
Yeah, catastrophic. And the impact it had on families and investors the like. I think it was a really good piece and he articulated that well.
Yeah, it's super interesting. The other part that came across to me and there's a bit, I'm a bit more exposed to the team and I know Alex and Tim, they're super capable people alongside him. And, it's interesting how they've built alongside him with a really capable team now, but they're quite prepared to be really long-term focused and be patient. And he spoke about this, which I thought was really interesting, about the alignment of interest. And he was talking about the business partner and the deal that went wrong in Europe. And he said, what was the biggest mistake? And the partner that they were dealing with was very focused as a funds management group on transactions and getting money from transactions rather than getting money from their underlying investors have a good result. And I think it's just, we always bang on about alignment of interest.
I was about to say alignment of interest.
And that in any investment management process, I think understanding how the manager or the person makes money and ensuring that aligns with how you make money is just really important. And he really emphasized there that they picked the wrong partner because their interests weren't aligned. So I think that's a great take out of it. I was really also interested in the view on office and, it was kind of interesting. He sort of said, at a high level, these people are going to work from home. No, they're all coming back. I'm going to send them an email at 1:05 to come back. I'm not convinced that's the case. I think there's a hybrid thing going on here. In the US, I think it's far, far higher. And I actually think AI, for instance, but, I'm conflicted because maybe it comes back a bit more because I kind of think a lot of those jobs that were being done at home, for instance, I knew of some large insurers where they'd put all their claims department and a lot of processing people, they can work from home. And, they've a couple of floors of the Sydney office now, they've got that rent back. However, I think a big part of that might be taken by AI now.
Yeah.
Right. So if I think about an AI world and I think about what I talk to my kids now who've just going and just finishing uni, I'm talking to them about it's the human interaction, it's the creativity, it's the problem solving, it's the managing teams, which needs to be done face to face, not remotely. So, but I don't think it's going to be the same demand level as it was 20, 30 years ago.
It's a tough balancing act. And you think of businesses with software developers, by example, and they've figured out a way to navigate that and communicate quite efficiently with ticketing systems and management overlays and meetings to manage that whole work from home environment. I think a lot of professional services businesses haven't quite got there yet. So it'll probably sit somewhere in the middle. That's my view. But
right on the fence there.
Right on the fence is where I'm happy to sit. And I think the other thing that was really interesting, my final takeaway was just his thoughts on private debt. I think a lot of the property managers in the last few years have really struggled. They've come up against private debt managers offering 10% per annum versus their funds targeting 10% in a good environment. They've rolled into 2022 when interest rates have gone up. They've had a significant headwind against them. And now they're finally coming out the other side of that. So hearing him acknowledge, I guess, the existence of private debt and not dismissing it at all, but just flagging, look, there are still cycles to be worried about there and just to be careful.
Yeah, good point. Good point. Thanks, Tom. Thanks, everyone. Hope you enjoyed the episode. Feel free, love your feedback. Send it through. You can email me at david.clark@codacapital.com. And remember the disclaimer at the end of the podcast to listen to that and be reminded that the podcast is recorded for informational and entertainment purposes only. It isn't advice.
Thank you for listening to Inside the Rope with David Clark. Be sure to subscribe to this podcast on iTunes. You can connect with David by visiting codacapital.com. Any views expressed in this recording represent the personal opinions of the speaker and do not represent the view of any other party. If this recording contains reference to any financial products, that reference does not constitute advice or recommendation and may not be relied upon. Listeners in Australia are encouraged to visit www.moneysmart.gov.au to obtain information regarding financial advice and investments.